This is a financial fundamentals snapshot of NVIDIA Corporation, pulled directly from SEC Edgar data. Let's walk through valuation, profitability, balance sheet strength, and what it all means for how this company is being priced today. NVIDIA's market capitalization sits near $4.85 trillion, one of the largest of any public company. That's not just a chipmaker premium. With a 71% gross margin and a debt-to-equity ratio of just 0.04, the market is pricing NVIDIA more like a software or platform business than a traditional semiconductor cycle. The stock trades at $199.44 a share, at a PE of 40.7 times. That's a real premium. It means investors are paying 41 times trailing earnings, which only makes sense if growth keeps compounding. Book value per share is just $8.04, so almost all of this valuation rests on future earnings power, not net assets. Here's why that premium holds up. Gross margin is 71%. Operating margin is 60.4%. Net margin is 55.6%. Each step down is small. The business isn't losing margin to overhead. Return on equity is 61%, and return on assets is 46%, both exceptional. And since leverage is minimal, those returns are coming from the business itself, not from borrowed money. The balance sheet backs this up. Long-term debt is just $8.5 billion against $13.2 billion in cash and $259 billion in total assets. A debt-to-equity ratio of 0.04 means NVIDIA is funding growth almost entirely from its own cash flow. On scale, annual revenue is $215.9 billion, and net income is $120 billion. Roughly 56 cents of every revenue dollar reaches the bottom line. Diluted EPS comes in at $4.90. So, strengths and risks. On the strength side, high margins, high returns, and almost no leverage. On the watchpoint side, a 40.7 times PE already prices in continued growth. Operating expenses are starting to scale with the business, and the earnings story is heavily concentrated in AI and data center demand, a single cycle, not a diversified mix. 5 heuristics to take away. 1. Judge margins, not unit volumes. 2. Leverage isn't doing the work here. Returns come from operations. 3. The PE is the real risk to watch, not the underlying business quality. 4. The balance sheet gives optionality. Cash and low debt fund growth without needing outside capital. And 5. At this scale, even small percentage shifts in margin move billions of dollars in value. All figures come from SEC Edgar's Company Facts and Submissions data, CIK 000-101-45810. This is an educational summary, not investment advice. It doesn't account for anyone's individual financial situation. Please consult a licensed financial advisor before making any investment decisions.